Good morning. Welcome to the Money Matters of the week ending March 27th, 2026. Spring is here, waiting for that warm weather. So we got two things for you today. The first is I wanted to announce a new free offering we have that's available to all our clients, your friends, your family, and I think it's going to be a great resource. So starting on the first and the third Thursday of every month going forward from 1 o'clock to 2:30 Eastern Standard Time, we're going to have a program called Ask the Advisor Anything. And so during this time, anyone can call in with any specific random questions they've been wanting to ask, and they'll either get connected to myself, to Trendon, or to Brendan, and we can field any questions you might have that maybe you've been thinking about and you didn't quite email, but just want to have a discussion. So that's available to everyone. We'll send some more information on that below. Okay, now, as we are getting into April, hopefully you are close or already have your taxes filed. And it's something nobody likes doing and it's frustrating. And so we're going to go through a little bit of the findings of a tax return. And I'm going to show you, I've hid the name to protect the innocent, of course. But every year I think a lot of people are like, yeah, that was painful. I really want to make it less painful. So one of the things that causes it to be painful is when you owe money. And a lot of times that happens when you don't withhold enough money, quite simply, or you had a big bump in income, but you didn't change your withholding. So, the tax preparers and CPAs, God bless them, their main priority is to get these returns done and filed. They don't have a lot of extra time where they're typically going to walk through this with you. Some do, but it's normally to try to get this filed and move on to the next. And so this is a report that is available for all our planning clients, and we're typically going through this once a year to kind of explain where you're at. So let me give you some ideas. First thing, this is based on a 2026 estimate. So we're looking now for this client for next year. But I want to point out a couple things that will apply to a lot of people. All right. So when we talk about taxes, a lot of people wonder, well, what am I paying? Right. So this is a couple. Their total tax was $13,077, or will be. That's our estimate for 26. Now, there are 5 marginal brackets. They start at 10 and they go all the way to 37. I said 5. I'm wrong. It's 7. I was thinking 5. And a lot of people think, okay, well, geez, if I'm in a 35% bracket, then I'm paying everything at 35%. That's not true. It's a progressive system. So it helps. This report helps you understand, okay, these folks, they were in a 22% bracket, but their average rate, what you average pay in federal tax, you take your total tax and divide it by your total income, and it's 8.8%. So, they're under 10% on average, which is pretty darn efficient. Okay. And then it's going to show some other things. They had some dividends. They didn't really have any capital gains. If we were trading and taking losses and carrying forward, we'd show that. And then, as most of you know who are on Social Security, for almost all of our clients anyway, it's 85% taxable. It's actually based on your level of income. But again, when we do projections, if we take less income, sometimes we can reduce that taxation. So one of the things that I think is really important, you don't need to understand everything, but you should understand, what bracket you're in and what your average rate is, because that essentially is great information for knowing, all right, well, effectively, how much do I need to withhold? So again, if you're in a situation, most of us, we're reviewing this with you anyway, but if you're not a client or you're maybe just want to talk about this more, we can go and look at your paychecks if you're still working, or look at your other withholdings if you're retired, and sort of make some recommendations to get you close. Now, it's not a guarantee, and if you have big changes we don't know about, that changes, but it at least keeps you from getting surprised. So just to clarify, because a lot of people have questions on this. So the way that it works, and this is for a married couple, it's different for a single person. Your first $24,800, you pay 10% federal tax. The next $76,000, you pay 12. The next from 100 to 211, you pay 22. The next chunk's 20. So the more you make, the more you pay. But again, it doesn't automatically, like if you made 500,000, every dollar is not taxed at 32%. Okay. So it's a little better than people think. But this is important because let's say somebody made 415,000 taxable. Well, they're at a 32% tax bracket. But if we could find 15,000 in deductions, maybe funding some IRAs, funding some 401k, et cetera, we could drop them back to 24%. So that's 8%. And that's real money right there. Okay. Another thing is capital gains. So most clients pay little tax on capital gains. If you're under 100,000, you're retired. You typically won't pay any on capital gains. It's a great uh, loophole. A lot of our clients fall here, and so capital gains, 15% better than the ordinary income. So we're always trying to look for capital gains, and I should specify long-term capital gains. Short-term capital gains, less than 12 months, are taxed at ordinary income rates. Again, another strategy. If you've ever heard the quote, Warren Buffett pays less taxes than a secretary, this is why. Because Warren Buffett he doesn't actually pay less, but he pays a lower percentage because his secretary is probably at a 32% ordinary income rate. Warren Buffett gets all his income off capital gains. He's at a max rate of 20%. So as a percentage, yeah, he's paying less than a lot of people. He's paying a lot less than me. Okay, here's another one. This is really important for those of you that are over 65 and on Medicare or going to be on Medicare. And this one is a sneaky one. I don't like this one. So most of you are familiar that there is a premium you pay for Part B, and there's a premium you pay for Part D, which is the prescription. And for Part B right now, it's a little over $200 a month. What a lot of people don't realize is there is a surcharge that they will charge you more, it could be a lot more for your Medicare if you made a lot of money. And so the threshold for 2026 was $227,000. Now, if you notice, why does it say 2028? Here's where it's sneaky. They base this on your income 2 years prior. So for those of you who are on Medicare right now, your 2026 rates are based on your tax return in 2024. And that's why we like to go through these with people, because if you had a big year, maybe you sold a business, maybe you took a bunch of money out, you might say, okay, well, I had that year and I paid my taxes. And then wait a minute, 2 years later, that Medicare premium, and it could get pretty nasty. You had $1 million, it's an extra $506 a month per person, plus an extra $94. So you're talking $1,200 a month extra. It's very sneaky. So just something to watch out for. Social Security, for those of you that are interested, yeah, if you can get no taxes on Social Security, but you have to have a very little income. It's one half your Social Security benefits plus all your other income. For a married couple, has to be under 32. For almost everybody, they're going to have it. And then down here, this just sort of breaks down how much is taxable. And then we have all these different things that'll tell you that you qualify for or don't qualify for. So as an example, that new SALT deduction, state and local taxes, it went from $10,000 limit to $40,000 limit. And if you are under $505,000 adjusted gross income, you can use that. So a lot more people are looking at itemizing now. These folks, could make a Roth IRA contribution if they had earned income. They could do an IRA contribution. So again, this report, we're happy for those of you who are clients to look for it. If you're not a client and you want to know more, it might be a good reason to talk. But the main thing with taxes is just don't just file and be done with it. Take some time to really look through and understand, okay, what happened here? How can I plan accordingly for next year? How do I make sure I don't pay any more than I have to? And that doesn't start at the end of the year, right? It should have started in January, but look, we're in March. That's better late than never. It starts now, and plan throughout the year so that there's no surprises next year. So with that, thank you for watching. We appreciate your business and trust. Remember, we are here for you, your family, and friends, and have a great day.